Good evening, students. Welcome to the session. So, today, what we are going to discuss is the significant amendments which are applicable for your attempt, significant judicial updates which are there for your attempt, right? So, that is what we are going to cover in today's session. So, how are we going to cover? We are going to go chapter wise that what are the amendments which are applicable for your attempt. Let me reshare the screen again. Yes. So what are we going to do in today's session is first we will look at the statutory updates and then we move on to the judicial update. So we will go as per the chapter wise changes that have taken place, as per the section wise changes that have taken place for your attempt, and that's how we are going to start with it. Okay. So you are also going to tell me that what are the changes which are applicable in specific chapters so that you also start revising, as you know that this is going to be a revision session. The way we have conducted in past, I'm expecting the answers from you also, so that you also keep revising, and that way your amendments will also be you will be able to remember and recollect everything. Okay. So let us start very quickly with the particular amendments which are there for your attempt, right? So there's one question that, whether Income Tax Act 1961 only will be applicable to your examination. Yes. So Income Tax Act 1961 only is applicable to you. You don't have Income Tax Act 2025 yet applicable to you. Fine. So you don't need to worry about that as of now. Fine. So first of all, is there any amendment in the tax rates? Yes. Is there any amendment in the tax rates? Any particular amendment that has taken place in tax rates? Yes or no? I'm asking you. Has there been any amendment in the tax rate, students? Yes. What is the default tax regime? What is the default tax regime? Has there been any amendment in that respect? What is the tax rate and the default tax regime? Up to 4 lakh, it is nil. 4 lakh to 8 lakh, it is 5%. 8 lakh to 12 lakh, it is 10%. Right? 12 lakh to 16 lakh, it is 15%. Then 16 to 20, it is 20%. Then 20 to 24, it is 25%. Right? And over and above 24 lakh, it is 30%. Yes or no? So these are the tax rates under the default tax regime. What are the tax rates under the old tax regime? Yes. What are the tax rates under the old tax regime, students? Is it same or has that changed? So it is same, right? Up to 2.5 lakh, it is 5%. 5 lakh to 10 lakh, it is 20%. More than 10 lakh, it is 30%. For resident individual greater than equal to 60 years, less than 80 years, up to 3 lakh, it is nil. 3 lakh to 5 lakh, 5%, then 20 and then 30. Then for resident individual greater than equal to 80 years, up to 5 lakh, it is nil. 5 lakh to 10 lakh, it is 20%, and greater than 10 lakh, it is 30%. Right? So there has been no change in terms of the tax rate under the normal provision also. Right? There has not been any change in the tax rate with respect to the normal income tax provision. Yes or no? What are the rates of surcharge? Has there been any change in the rates of surcharge? Yes. There has not been any change in the rate of surcharge. The surcharge remains the same. So For the surcharge, what is the tax rate under 115 BAC? It is greater than 50 lakh, less than 1 crore, 10%, greater than 1 crore, less than 2 crores, 15%. Then income greater than 2 crore, excluding dividend, LTCG, STCG, 25%, right? And on the STCG, LTCG and the dividend more than 2 crores, it is 15%. Under the normal tax regime, what is the surcharge? Surcharge more than 50 lakh, less than 1 crore, it's 10%. Greater than 1 crore, less than 2 crore, 15%. Where the total income is excluding dividend, LTCG, STCG, exceeds 2 crore, then 25%. If it exceeds 5 crore, then 37%. But on dividend, LTCG and STCG, it is restricted to 15%, even if that exceeds more than 2 crores. Yes or no? What is the rate of cess? 4%. Yes. Then what is the rebate? What is the rebate? Yes. Yes, students, what is the rebate? Faster? What is the rebate which is there applicable? Yes. I need the answers. So we saw the changes in the, we saw the tax rates, but what is the rebate? The tax rates have changed under only 115 BAC, right? But what about the rebate which is there? Faster? The rebate under 87A, under 115 BAC, right? If your total income is less than equal to 12 lakh, it will be 60,000 or the tax amount, whichever is lower. If the total income is more than 12 lakh, then the rebate will be the income tax minus total income minus 12 lakh. So the step one is to find out the tax on the total income. Step two will be to see what is the difference between the total income and 12 lakh. How much total income is increasing by 12. Step three will be 1 minus 2. That will be your rebate. And the rebate will not exceed the tax under 115 BAC. That is, you will not get any rebate on income chargeable at the special rates. Under the normal tax regime, what is the rebate? 12,500 or the tax amount, whichever is low. And in the normal tax, rebate is allowed for all the income, including the special income, except LTCG under 112A. Are we clear, students? Yes or no? So, you have to be very careful when the question comes on rebate, students. So, there is this amendment in the rebate under 87A, right? So, this particular amendment says that the rebate now is 60,000. Are we clear? And the deduction will not be available. The deduction of rebate will not be available against your special rate income if you are opting for 115 BAC. Are we clear, students? Yes or no? Okay. Now then, what are the tax rates for the partnership firm? The tax rate for the partnership firm LLP is 30% same. Surcharge is same. If the total income is more than 12 crore, it will be 12%. Clear? For cooperative society, what is the tax rate? Under the normal tax regime, it is same. Up to 10,000, 10%. 10,000 to 20,000, 20%. More than 20,000, 30%. Surcharge is also if the total income is more than 1 crore, less than 10 crore, it is 7%. If the total income is more than 10 crore, it is 12%. Under the optional tax regime, you have 115 BAD, where is 22% plus 10% surcharge plus 4%. You have 115 BAE where the manufacturing cooperative society is 15% plus 10% surcharge and plus 4% cess. Right? Then what about the corporate company? Yes, the general tax rate is 30%. Small company, if the turnover in the previous year 23-24 is less than equal to 400 crore, it is 25%. Optional tax regime, you have 22% and the 115 BAA and 115 BAB, it is 15%. So that remains the same even now. Foreign company, what is the tax rate? 35%. Total income more than 1 crore, less than 10 crore, surcharge is 2%. Otherwise, if it's more than 10 crore, surcharge is 5%. Yes or no? So the only tax rate change that you see is for the individuals. Are we clear? Yes. Is that clear, students? Any questions, any doubt till now? Yes or no? Yes. Is this clear to everyone? If you have any questions with respect to rebate, with respect to tax rate, you can please feel free to ask. I hope this is clear to everyone. Okay? Yes? Fine. Then moving on to the next particular amendment. So, is there any amendment in the chapter salary? Yes. Is there any amendment? Yes or no? No, right? No amendment over there. Any amendment in the house property? Yes. Yes, Rekha. Yes, Rekha, you can. You have a question, Rekha? Okay. You're not able to hear me. आवाज बराबर नहीं आ रहा है क्या? अशोक जी? अशोक जी? आवाज नहीं जा रहा है क्या बराबर से? स्टूडेंट कंप्लेन कर रहे हैं.
मैम नेटवर्क का प्रॉब्लम होगा उधर.
जी?
नेटवर्क इशू होगा.
मेरे यहाँ तो कोई प्रॉब्लम नहीं आ रहा है ना.
नो मैम, नो.
Okay. Rekha, there may be some issue at your end. So you can please check. Okay. Yes.
मैम इन्होंने आईडीओ ज्वाइन नहीं कर रखा है, रेखा.
ज्वाइन नहीं, कहाँ से ज्वाइनिंग किया?
मैम अपना आईडीओ ज्वाइन नहीं कर रखा है. ओनली
अच्छा.
वीडियो का हाँ ऑप्शन ज्वाइन कर रखा है.
ओके.
इसलिए प्रॉब्लम हो रही है.
Rekha, I think please you can disconnect and rejoin again in case there's some problem. Okay. Yes. So we were on this point of, is there any amendment under the house property? Yes. So section 23 of the Act, which relates to the determination of the annual value. Right? Section 23 of the Income Tax Act, which relates to the Determination of the annual value. What is the amendment over there? Yes. So it provides that where the house property is in the occupation of the owner for his self occupation or self residence, or if he is unable to occupy the property due to his employment. In that case, the annual value of the property is taken as nil. And this is applicable in respect of only two house properties. So you can take the annual value as nil for a self-occupied property, but only two house property you can take it as nil. Now, with a view to simplify the provision, the section 23 was amended to provide that the annual value of the property consisting of the house will be taken as nil if the owner is not occupying either due to employment or for any other reason. Right? So they've just simplified it. So what they've said is that the annual value of the property will be considered as nil if the owner is occupying either for his own residence or cannot actually occupy it due to any other reason. So even if he is not occupying for because of his employment, so earlier the word used were that the owner is not able to occupy because of his employment. If the owner is not able to occupy his house because of employment, but now they have replaced the word employment with any other use or for any other reason. So even if the owner is not actually able to occupy for any reason, not just because of his employment, in that particular case, also the annual value will be considered as nil for the two house properties. Are we clear? Yes or no? So earlier it was for only for the purpose of employment, business or profession. Now, even if he is living in the same place, so let's say for example, there may be a question asked in the examination. Let's say for example, I have a property in Mumbai. Now, in one house, I am living. I have another property in Thane. In that house, I am not living. Earlier, I was not living. Earlier, I could, get the exemption as nil, or earlier, I could claim the annual value as nil only when I was not staying in Thane because of my employment. Because of my employment in other part of Mumbai. But now, even if I don't occupy it for employment, even if let's say my employment is there in Thane only, but still I'm not living in that house. Still I can claim that as nil because of the amendment. So now it can be not occupied because of any reason. So if there are two properties, one is self-occupied, one is vacant, both of them can be taken, the annual value can be taken as nil. Are we clear? So that is the amendment with respect to section 23 of the income tax act. Clear? From safe harbor rules, Rekha, you can ask now, but I will reply it later. Okay? Fine. Any amendment in the business profession? Yes, what are the amendments in the PGBP? No amendment in the PGBP. There is no amendment in the PGBP chapter. Are we clear? So for PGBP, there is no particular amendment. The amendment was there in the house property, in the rates of tax that we discussed, 87A rebate. Right? There is no amendment in respect of PGBP. What is the amendment in capital gain? What are the amendments in capital gain? Yes. Yes, students, what are the amendments in capital gain? Faster. Yes. Yes, students. What are the amendments in section 45? Yes, rates are there. What else? Under section 45, what is the amendment? So, with respect to section 1010D, what is 1010D? What is section 1010D? Yes. What is section 1010D, students? ULIP exemption. Yes. LIC exemption. Life insurance premium exemption. That's right, Rekha. So, section 1010D, what does it provide? That's the income from the life insurance policy shall be exempt. Right? The income or the amount that is received from the life insurance policy is considered as the exempt, isn't it? So, that is exempt. Any sum received under a life insurance policy is exempt. But this particular provision does not apply if the premium exceeds 2,50,000. Right? If the premium exceeds 2,50,000 rupees. Isn't it? So if the premium exceeds 2,50,000, in that particular case, you do not get the exemption. In respect of unit linked insurance plan, in respect of the unit linked insurance plan, what is the threshold? What is the threshold for unit linked insurance plan? Yes. 5 lakh. Yes, correct, Rekha. The exemption is with respect to 5 lakh. So, when any sum is received, even under the unit linked insurance plan is exempt. But if the premium is payable, right, if the premium is more than rupees 5 lakh, then the exemption does not apply. Yes or no? Second condition is what? That the premium should not exceed 10% of the sum assured. Yes or no? Right? Now, ULIP is a capital asset. ULIP is considered as a capital asset under 247. Right? ULIP is considered as a capital asset only when the exemption under section 1010D is not applicable on account of the premium exceeding 5 lakh rupees. Right? Premium exceeding the 5 lakh rupees. Yes or no? So when the premium exceeds 5 lakh rupees, the ULIP is considered as a capital asset. Are we clear? And the income that is received is chargeable under the head capital gain. In case of life insurance policy other than ULIP, the sum is taxable under the head. Under which head? Under which head it is taxable? Income from other sources. Are we clear? Now, in order to rationalize the provisions for the ULIP, right? What they have said is that the profit and gains from the redemption of the ULIPs to which the exemption under 1010D is not applicable shall be charged to as capital. And ULIPs to which the exemption under 1010D is not applicable shall be included in the definition of the equity-oriented mutual fund. Are we getting this particular point? Yes or no? So, in respect of the ULIPs, there has been a change. Let me reshare the screen again. So, if you look at here in your module itself, to rationalize the provision for ULIPs, ULIPs to which the exemption under 1010D does not apply is classified as capital asset under 214, and the profit and gains from the redemption of such ULIPs shall be charged to tax as capital gain under section 45(1)(b). And the equity oriented fund definition is also amended to include all the ULIPs to which the exemption under 1010D does not apply. Yes or no? Yes, Rekha, that's right. So, in a case where you have the ULIPs to which the exemption is not applicable under 1010, in that particular case, what are the three amendments that we are talking about? The first one is ULIP to which the exemption does not apply under 1010D, right, will be considered as the capital asset. Will be considered as the capital asset. Under section 247. Right, 247 defines the capital asset, and under the definition of the capital asset, the ULIP is included when the exemption is not applicable to the ULIP. Yes or no? Is this first point clear? Yes? Any question? Okay? Any question, any doubt? Fine. Then, once it is considered under which particular section it is chargeable? Yes. Under which section it is chargeable? 45(1). 45(1)(b). The chargeability is there under 45(1)(b). There is a specific charge under section 45(1)(b). Right? 45(1)(b), if the ULIP to which the exemption under 1010D does not apply, will be chargeable under the head capital gain under 45(1)(b). Are we clear? Yes or no? Third, they have amended the definition of the equity-oriented fund. Now, equity-oriented fund will include the equity-oriented fund will include the ULIP. So, there is also amendment carried out under section 1128. Are we clear? So, once it is considered as the equity-oriented fund, what will be the tax rate in that particular case? On the long term or short term? 12.5% for long term, that's right. Yes. For short term? Yes. Yes, correct, Rekha, 20%. Are we clear? Now, why this amendment was introduced? See, ULIP is considered as a capital asset since many years. There is no doubt about it. So what is the amendment? What is the amendment that has been carried out? So the 1010D provision, right? What does it say? It says that the exemption will not be applicable on the amount received for the ULIP or the life insurance policy. Are we clear? However, there may also be no exemption, right? There may also be no exemption in a case where the conditions of the 1010D are not satisfied. So 1010D says the sum received under life insurance policy will be exempt. However, if the premium is more than 2.5 lakh for the LIC or 5 lakh for the ULIP, then the exemption under 1010D will not be applicable. The exemption will also not be applicable if the sum is received under keyman insurance policy. Right? If the sum is received where the premium is more than 10% of the sum assured. Are we clear? So the earlier references to all these sections was specifically for only where the premium is more than 5 lakh for ULIP. Only then the ULIP is considered as capital asset. Now they have removed that reference. So even where the premium is not more than 5 lakh, but where the premium is more than 10% of sum assured, or the sum is received in a keyman insurance policy. Right? In those particular cases, also the ULIP will be, the amount received at the ULIP will be considered as taxable under capital gain, because then ULIP will be considered as capital asset. Are we clear, students? Yes or no? Okay. Yes or no? Fast. What is the other amendment in capital gain? Yes. What is your other amendment in capital gain? Any other amendment? Yes or no? Yes, students, faster. Yes, what are the tax rates for the capital gain, long term, short term? Yes, what is the tax rate for long term capital gain? Yes, students. What is the tax rate for the long term capital gain? Is there any change in that? Yes. Faster. What is the tax rate for capital gain? Is there any change in that, students, or not? So the long-term capital gain tax rate remains the same, students. There is no change under that. Yes or no? There is no change in the long-term capital gain. It is 12.5% only. It was in the last year when the changes were made pre 23rd July 2024 and post 23rd July 2024. Right? For your attempt it is only after 23rd July 2024 you are going to look at it. Because the relevant previous year for your attempt is previous year 25-26. Isn't it? So therefore, for your attempt, it is just 12.5% over 1.25 lakh under 1128. For 112, it is straight 12.5%. For short term under 111A, it is 20%. Fine. So there is no change in the tax rate per se. Just 1 second. I'm sorry. Yeah. Now, is there any change in the income from other sources? Yes. Any amendment in the income from other sources? Yes. What is the amendment? There is no amendment under the income from other sources, students. Okay. Then any amendment in clubbing provision? No. There is no amendment in the clubbing chapter also. So I'm going chapter wise so that you know that if there is any amendment, particularly to a particular chapter itself. Okay. Then in respect of set off and carry forward of losses, is there any amendment? The answer is yes. There is an amendment in section 72A of the Income Tax Act. What is section 72A? What is section 72A? Yes. Carry forward and set off of losses in the case of amalgamation. So 72A and 72AA talks about the set off and carry forward of losses. 72A is for normal amalgamation. 72AA is for the amalgamation of the banking companies. Isn't it? So this provides that the losses of the amalgamating company, the accumulated loss and the unabsorbed depreciation of the amalgamated company shall be carried forward and set off by the amalgamated company for a fresh period of 8 years. Right? So it says that the accumulated loss and the unabsorbed depreciation of the amalgamating entity shall be deemed to be the loss of the amalgamated entity. Right? Now, section 72 allows you the carry forward and set off for a period of 8 years. The business losses can be carried forward and set off for the period of 8 years. So in order to align 72A so that the amalgamated company does not get the new fresh 8 years, because earlier the language of the 72A was such that the losses could be carried forward by the amalgamated entity for a fresh period of 8 years. So they used to get a fresh 8 years period. So now the amendment is carried out to provide that any loss which is there forming part of the accumulated loss of the predecessor entity to be carried forward for not more than 8 years from the assessment year for which the loss was first computed. So they will get the carry forward of the loss, but the loss will be restricted only to the 8 years period from the date when the loss was incurred. So the amendment is aimed to prevent evergreening of losses or renewal of the losses of the amalgamating entity into the amalgamated entity, and to ensure that the maximum period for set off of the loss is for the period of 8 years from the year in which the loss was incurred. The same amendment is applicable even under 72AA. So 72A is for the amalgamation of the amalgamating company, or the conversion of the firm, or the conversion of the proprietary concern into a company, or the conversion of a private company or unlisted public company into the LLP. Right? 72AA is for the amalgamation of the banking company or the government company, right, for them. Are we clear? Any questions, any doubts so far? Okay. Yes or no, students? Any questions, any doubt? Then, is there any amendment in the Chapter 6A deduction? Yes. Is there any amendment in the Chapter 6A? Yes. For the National Savings Scheme. What is the amendment? So, National Savings Scheme, there was an exemption provided on the withdrawals from the National Savings Scheme. Section 80 CCA provides for a deduction to individual or HUF for any amount deposited in the National Savings Scheme. Right? And where the amount together with the interest which is there, if it is withdrawn, it shall be deemed to be the income of the assessee and shall be chargeable to tax. Right? But this provision was applicable until 1/4/1992. This provision was applicable until 1/4/1992. Right? If you look at it, no deduction would be allowed in relation to such amount deposited after 1/4/1992. However, the NSS accounts were still operational. However, after 1st October 2024, because of this Ministry of Finance rules for the National Savings Scheme, these schemes would not generate any interest. Right? So, consequent to this notification, depositors who had intended to leave their NSS balance untouched for future use will not get any interest and will be compelled to withdraw their balances, making these amounts taxable. So Section 80 CCA has been amended to provide the exemption to the withdrawals on or after 29th August 2024 for the amount deposited under the scheme and the interest accrued thereon in respect of which a deduction has been allowed. Are we getting this? Yes or no? Any questions, any doubt? So this is a very, very small amendment. Okay. Then what else is the amendment in 80, Section 80 CCD? What is the amendment in Section 80 CCD? Yes. For the Unified Pension Scheme. What is 80 CCD? Pension Scheme. Isn't it? 80 CCD is the pension scheme, National Pension Scheme. So there is also a National Pension Scheme Vatsalya, which was launched in 2024, which enables the parents and guardians to start the NPS for their children. This is a saving cum pension scheme which is designed for the minors, but will be operated by the parents or the guardians for the benefit of the minor till they attain the majority. So when the minor becomes 18 years, the account will be transferred to the child name with the accumulated corpus and will be shifted to the NPS Tier 1 account. So now the 80 CCD has been amended to say that the deduction will be allowed to the parents or guardians' total income of the amount paid in respect of the credit to the minor, up to a maximum of 50,000. The maximum limit will be 50,000 only. The maximum limit will be 50,000, which is allowed for the NPS. So combined for their own contribution, for the minor's contribution will be 50,000. Are we clear? Secondly, the amount on which the deduction has been allowed will be charged to tax if the amount is withdrawn. However, if the amount is received on the closure of the account due to the death of the minor, it will not be considered as the income. Because the NPS Vatsalya scheme also allows for a partial withdrawal from the account for maybe the education or illness of the minor. So therefore, even under section 12, under section 10, an amendment has been made which now provides that any income received on partial withdrawal made out of minor's account will not be included in the total income of the parent to the extent it is not exceeding 25% of the contribution made by them. More than 25% contribution, any income received from the withdrawal will be taxable in the hands of the parent. Are we clear? And even the deduction which has been allowed will be charged to tax in the year of withdrawal. Fine. Any question, any doubt? Yes or no, students? Okay. Then there has been amendment in section 80 IAC. What is 80 IAC? Yes, students, what is 80 IAC? 80 IAC is the deduction given to the eligible startups, right? The startup which is incorporated between 2016, 1/4/2016 and 31st March 2025, right? Which are recognized by the DTL IT. So now that 2025 timeline has been extended from 2025 to 2030. So the startup is required to be incorporated between this window. This time limit is extended from 31st March 2025 to 31st March 2030. Okay. So the ITIAC provides for a reduction of the 100% of the profit and gains derived from the eligible business by an eligible startup for 3 out of 10 years, beginning from the year of incorporation. So the startup should be recognized. The startup should not have turnover more than 100 crore and should be incorporated between 2016 and 2025. This 2025 time limit has been extended to 2030. Are we clear? Yes or no? Okay. Any questions, any doubts so far? Same has been done under ATLA. What is ATLA? What is the deduction under ATLA? Deduction in respect of the banking unit and the IFSC units. Right? So, where the gross total income of the banking unit or IFSC unit includes their profits, that entire profits are considered as the or are allowed as the deduction. Right? The profits are allowed as the deduction. However, there also the condition is that the income should be from the offshore banking unit, either located in SEZ or from a unit in IFSC, or arising from the transfer of the lease of the aircraft or ship, provided that the operations have been commenced before 31st March 2025. Now this again 2025 time limit has been extended to 2030. Are we clear? Yes or no? Are we clear? Any questions, any doubts so far, students? So that covers the amendments in the chapter 6A deductions. Okay. Then after chapter 6A deductions, under the other provisions, what are the amendments? So we'll take one by one here. The expansion of tonnage tax scheme. What is tonnage tax scheme? Yes, what is a tonnage tax scheme? Yes, what is a tonnage tax scheme, students? It is a kind of presumptive scheme. It is a kind of a presumptive scheme for the Indian resident shipping companies. Now, this scheme has been extended to the inland vehicles also, or inland vessels also. It was not earlier given to the inland vessel, that has been extended to inland vessels also. Are we clear? Any questions, any doubt? Yes or no, students? Yes. Yes, students, I need the answers. Okay, fine. Now then, what are the other amendments? Let us talk about the amendments under the TDS and TCS. TDS and TCS. So what are the changes in the TDS and TCS? Yes. What are the changes? Let us talk about each section wise. Whether there is change in 192. Yes. Under salaries, is there any change? Yes or no? Any change under 192 for salaries? No. There is change in section 193. What is the change in 193? Yes. So 193, the threshold has been increased from the nil for interest on securities to now rupees 10,000. Yes or no? So earlier the threshold was nil. Now the threshold has been increased to the 10,000 rupees. So remember, these are very important changes in the TDS. You have to remember these. For interest on securities, earlier the TDS used to be from 1 rupee itself. Are we getting this particular point? And in respect of interest payable to an individual or HUF on any debentures, the limit was earlier 5,000. Now that is also made to 10,000. So under 193, the interest on security, the limit is 10,000. 194. Again under 194, for dividend for an individual shareholder, only for an individual shareholder I am talking about. The earlier limit was 5,000. Now that has been increased to 10,000. Under 194A, what is 194A? Interest other than interest on securities. So earlier the limit was 40,000. Now it has been raised to 50,000. And where the limit was earlier 50,000 for the senior citizen, it has been now kept as 1 lakh rupees. Are we clear? And this is where the payer is a bank, cooperative society and post office. Right? Where the payer is the bank, cooperative society or the post office. However, when the payer is other than bank, cooperative society, earlier the limit was 5,000. Now it has been extended to 10,000. Okay? Yes or no? Any question, any doubt? Fine. Then we have change under 194B. What is 194B? Winning from the lottery, crossword puzzle, etc. So earlier the limit was aggregate of the amount exceeding 10,000 during the financial year. Now it is 10,000 in respect of a single transaction. So this has changed. Earlier it was aggregate of the amount exceeding 10,000. Now it is 10,000 for single transaction. Okay. Then you have 194BB. What is 194BB? Winning from the horse races. Again in that, earlier the limit was 10,000 during the financial year. Now it is 10,000 in respect of a single transaction. 194C, any change? No change. There is no change in the contractor payments. Then directly you have change in 194D. Insurance commission. Earlier the limit was 15,000. Now it has been extended to 20,000 for insurance commission. Okay. Then 194G. Income by way of commission or price on the lottery tickets. Again, earlier the limit was 15,000. Now it has been raised to 20,000. Then 194H, which is commission or brokerage. Again, there the limit has been increased from 15,000 to 20,000. Then 194I, rent. Earlier it was 2,40,000 for the entire financial year. Now this has been extended to 50,000 per month for rent. Okay. Fine. Then under 194J, for fees for professional or technical services. For fees for professional or technical services, the limit has been increased from 30,000 to 50,000 rupees. Fine. 30,000 to 50,000 now. In 194K, which is income in respect of the units, it has been increased from 5,000 to 10,000. Then you have, just give me a minute. I think I just closed the page itself. Yeah. 194LA, which is income by way of enhanced compensation. Enhanced compensation on what? On the compulsory acquisition of the land. Isn't it? So on that there is TDS under 194LA. So the limit has been substituted from 2,50,000 to 5 lakh rupees. Okay. Are we clear? Any question, any doubt so far? Yes, students. Is this clear to everyone? Whatever we have discussed so far? Yes or no? Yes. Then there is also the change in the rates of tax, TDS. For 194D, which is insurance commission, the TDS rate was 5% and this has been reduced to 2%. So under 194D, first of all, there is change in the amount, the threshold. Are we clear? And there is also the change in the rate of the TDS for the insurance commission. Are we clear? Then again under 194 LBC. What is the change under 194 LBC? Under 194 LBC, it was earlier 25% if the payee is individual or HUF and 30% otherwise. Now it has been directly put to 10%. Are we clear? The rate is now going to be 10%. So there are these two changes in the rate of the TDS. Sure. Any questions, any doubt? Yes or no, students? Any questions, any doubt? Yes. Okay. Is this clear to everyone? Okay, fine. Then, in respect of the TCS, let us look at the changes with respect to the TCS. What are the changes in TCS? And one important change with respect to the TCS on the sale of the goods. So, for the TCS, there was TCS in respect of the sale of the goods, if you recollect. Right? There is a TCS in the respect of sale of goods which used to be there earlier. So, that used to provide that any person who is a seller who receives the consideration for the sale of goods more than 50 lakh had to collect the tax at the rate of 0.1% of the sale consideration more than 50 lakh. And then there was TDS in respect of the purchase of goods under 194Q, which requires any person being a buyer to deduct the TDS at the rate of 0.1% on the payment made to a seller for the purchase of goods more than 50 lakh. So TCS was on the seller, TDS was on the buyer. So 2061H was on seller and 194Q was on the buyer. Now the TCS provision provided that the TCS will not apply if the buyer is deducting the TDS. So it became very difficult for the seller to check whether the buyer is deducting or will deduct, and to therefore facilitate this ease, to remove that confusion that whether the seller will collect TCS or buyer will deduct TDS. The amendment is made and this TCS on the sale of goods has been done away with, has been abolished. So with effect from 1st April 2025, the TCS on the sale of goods has been abolished. And only now the buyer is required to deduct the TDS under section 194Q. Are we clear? So this is a very important amendment. Okay. Any questions, any doubt? Okay. Then what are the other changes in respect of the TDS and TCS? Yes. For TCS again, there are few changes. Let us have a look at it. So in respect of again the TCS, right, there has been the revision in the limit for the LRS, remittance under the LRS and overseas tour package. So with respect to that, the limit was 7 lakh rupees. Earlier, the threshold was 7 lakh rupees for remittance under the LRS and overseas tour package. Now that has been extended to 10 lakh rupees. Are we clear? Any questions, any doubt? Fine. Secondly, with respect to the rates of TCS. In respect of TCS on timber or any forest produce not being tendu leaves obtained under the forest lease. Earlier, the rate was 2.5%. Now it has been kept to 2%. And with respect to the TCS on, the remittance for the purposes of the education under the LRS, where the education is financed by the loan from the financial institution. Earlier it was 0.5%, after 7 lakhs. Now it has been provided that there will not be any TCS in that case. So when the remittance is made for the LRS, remittance is made for the education under the LRS, in that particular case, it will be nil. When the remittance is made in the LRS for any other purposes for education, which is not sponsored through loan or which is not through the loan, then normally your TCS will be applicable, which is over rupees 10 lakh. Are we clear? Any question, any doubt? Yes or no? Yes or no? What is the TCS in that case? 5%. Okay? Fine? Yes, students, any question, any doubt? For only the education finance to the loan, it is nil. Fine, so this is the change in the TDS and TCS. Then there was one section which provided for higher TDS or TCS for non-filers of the return of income. Non-filers of the TDS and TCS for the return of income. So in that case, the higher rate used to apply. The higher rate used to be applicable. Yes or no? So what was that higher rate? If you recollect, if somebody has not filed the return, right? Then the TDS was at the higher rate when the deductee is a non-filer. Right? So now that section has been completely omitted. So earlier section 206AB used to provide for a higher rate. Okay. Now that section has been completely abolished. So even if the deductee or the collectee has not filed the return, then also there will not be any higher rate applicable. Clear, students? Any questions, any doubt? Okay. Yes, for the overseas tour package, it is 20% over 10 lakh. For education, for LRS, for medical, it is 5%. Okay. And if the education is from the loan taken, there is no TCS. Okay. Fine. Okay. Then what are the other amendments which are carried out under TDS, TCS? Yes. Yes. For the non-filers, yes. For the TDS as well as TCS, for both of them, it has been abolished. So earlier, it used to be twice the rate or the rate at the 5% in case the deductee or the collectee is the non-filer. But now that has been completely abolished. Clear? Okay. Any doubts, any questions that you have? Fine. Now, what are the changes in the other tax rates which are there? Other than this, any special tax rates? Are there any changes? Yes. Are there any changes with respect to the tax rates? Yes, students, I'm asking you, are there any changes in the tax rates under section this 115, which are there, special provisions for the taxes, special tax rates which are there? So as I said, under 112A, there is no change. Under 111A, there is no change. Under 115 AD, which is the finance for the foreign portfolio investors and foreign institutional investors, the tax rate has been changed from 10% to 12.5%, which is same as long-term capital gain. Right? So that has undergone a change. Okay. Any other change? Yes or no? Other than that, there is no change in the tax rate. Is it clear? So the tax rates under 115 BAC have only changed. For the foreign portfolio investor, they have extended this 12.5%. Besides that, there is no change in the tax rate with respect to the any special tax rates also. Clear? So you have to just remember for 115 BAC, the rebate which we have discussed so far, only those things have undergone the change. Other than that, no change in the tax rate at all. Okay? Any questions, any doubt before we proceed further? Okay. Then what are the now changes in the assessment procedures? Any changes in the assessment procedures? First of all, for filing the return of income under 139. Yes. What is the time limit for that? So for the updated return, earlier the updated return could be filed up to 24 months from the end of the relevant assessment year. Now the time limit for updated return has been extended to 48 months from the end of the relevant assessment year. However, one has to pay the additional tax in respect of that. So if the updated return is filed up to 24 months, whatever the tax rate was, that remains the same. The additional tax remains the same. However, when now you're filing after the period of 24 months and up to 36 months, you have to end up paying 60%. Are we getting this? You have to end up paying 60%. And if it is after 36 months and within 48 months, then in that particular case, it will be how much? 70%. So this is the tax on the or the additional tax on the updated return. Are we clear? So if you are filing within 12 months, it was always 25%. If you are filing after 12 months, before 24 months, it is 50%. If you are filing after 24 months, before 36 months, it is 60%. If you are filing after 36 months but before 48 months, then it is 70%. Are we clear? So that has been the change with respect to the timeline for filing the updated return. For the normal return, the timeline still remains the same. Okay. So that has been the change in respect of the updated return. Then there has been change in respect of the assessment procedure also. Right? There has been change for the assessment proceedings as well. Now, what is the change? With respect to the search and requisition cases. With respect to the search and requisition cases, there has been the change which has been carried out in respect of the block assessment. Right? So, the concept of block assessment is introduced where a search is initiated or requisition is made. Okay. So, now what they are trying to say is that in respect of the search cases, the assessment which will be carried out whenever the search takes place, in that particular case, there will be a concept of block assessment which will be followed. So how this block assessment is carried out? This block assessment which is there is carried out under section 158. under section 158, the block assessment is carried out. The time limit for block assessment is changed from 12 months from the end of the month to 12 months from the end of the quarter in which the authorization for search or requisition has been executed. Are we clear? So, the time limit is remaining the same. But what they have changed here is that from the end of the month, they have introduced the end of the quarter. They have introduced the end of the quarter. Are we clear? Any question, any doubt so far? Okay. So, the 12 months still remain the same. However, it will be from the 12 months from the end of the quarter. Any question, any doubt? Yes. So now the entire 158 BA will provide that any assessment or reassessment or recomputation or reference or any order pertaining to assessment year which is falling in the block period, which is pending on the date of initiation. So if any assessment is pending as on the date of initiation of the search or on the requisition, that will abate. Right? And if any proceeding has been annulled in any appeal or any other legal proceeding, then the assessment or reassessment relating to that assessment year which has abated shall revive. Are we clear? Fine, students. Any question, any doubt? Okay. Clear? So this assessment for the search and seizure cases is very, very important. Also, the term virtual digital asset has been added to the definition of the undisclosed income, which is defined in the 158B. So now the term virtual digital asset has been specifically introduced so that in case there has been any virtual digital asset found out as the undisclosed income, even in that cases, the assessment can be taken up or the search can be initiated in that respect. Are we clear? Okay. So with this, let us take a break of 10-15 minutes and then we start back again. Ashok ji? Break start. we have discussed about the amendment with respect to the search and requisition, right? As I told you that now that there is this concept of block assessment which has been introduced. So in that respect, you have to be very careful with respect to that. Like, how do you write your answer in the examination? A question can easily be targeted around this particular area again with respect to the search and survey proceedings or search and requisition proceedings, because the assessment for the search cases is now contained differently, right? So you have to be careful with respect to that aspect. Now, also, with respect to this virtual digital asset inclusion, you have to be again careful to see that, you are including those particular cases also within this unexplained income. So again, that can be considered as an unexplained income, as I told you. So that again, a question can be asked around that particular area as well. A question can be asked with respect to how the proceedings entirely are conducted, what are the time limits. So as I told you, you need to remember it is 12 months from the end of the quarter and not end of the month, right? It is 12 months from the end of the quarter. It is not at 12 months from the end of the month as it was earlier. So again, the time limit you need to recollect, right? So these are the things that you need to be careful about when you are writing the examination with respect to the uh, kind of questions that can be asked in the exam. Okay. Now, as I said, under 132, there is the power to search and seizure which is given. There can be question around that particular area also. There can be then question around the separate assessment of the search cases, which is a block assessment system which has been initiated now. Then there can be question around like what are the powers given to the officer in respect of the search. So those are the questions you can expect around these. Like it will not be obviously a sum, right? There cannot be a sum for this. But there can be, case scenario based question in respect of the search cases. Yes or no? So you have to be prepared for that. Right? So what are the changes once again? Number one is the concept of the block assessment. Second, the undisclosed income will now include the virtual digital asset. Third is the time limit which has been introduced, that the time limit will be uh, from the 12 months. Then what is the amendment that I told you with respect to the updated return, with respect to the pending assessments? Yes. What is the time limit with respect to that? Yes. What is the time limit with respect to this? Pending assessments. That the pending assessment which are there shall be not considered, shall abate. Yes or no? However, if any search proceeding has been annulled in any appeal or any assessment proceeding has been annulled, that shall be revived. Yes or no? So again, that thing you need to take into consideration. That what will be the status of the pending assessments? Yes or no? So where a search is initiated under 132 or the requisition is made under 132A after 1st September 2024, now the concept of block assessment exists under Chapter 14BB. For all other cases, the assessment under for the reopening 147 to 151 will be applicable. For the search cases, you have a specified chapter now which is there. Okay. So in that particular case, whatever the pending assessments are, so let's say there is any 148 pending, 147 pending, 143 pending, all of that will be abated. But if there is something which has been annulled, that shall be revived. Are we getting this particular point? Yes. So, with respect to the block assessment, right, what will happen is the period comprising relevant to the 6 years preceding the year in which the search was initiated. All of that will now be assessed together. Okay. And this has been done to have a separate framework for the search cases. Okay. So, the period comprising previous year relevant to the 6th assessment year, that is the block period. It also includes the period starting from 1st April in the year in which search is initiated and ending on the date on which the authorization for search was executed. So, for example, if the search was initiated in December 2025 and the last of authorization executed on 18th December, the block period will comprise of 6 years prior, that is 24, 25, 23, 24, 22, 23, 21, 22, 20, 21, 19, 20, and will also include a period from 1st April to 18th December. And where a search is initiated in the case of any person, then the AO shall proceed to assess the total undisclosed income of the block period. Now, undisclosed income will include any money, bullion, jewelry, virtual digital assets, or any other valuable article or thing, or any expenditure or any income based on any entry in the books of accounts. Are we clear? So, any undisclosed income for the block period will be assessed by the AO. Any assessment pending on the date of initiation of the search shall abate. Any assessment pending under 143.3, 147, anything. And if any proceeding for assessment which is falling in the block period, for which a notice has been issued during the period commencing from on the date of initiation of search, shall abate, and if any proceeding which has already been annulled in any appeal or any other legal proceeding, then the assessment or reassessment or even reference to the TPO shall revive. Are we clear? Any question, any doubt? Clear? And the undisclosed income relating to the block period shall be charged to tax at what rate? At the 60% under section 113. Clear? Now, what will be my undisclosed income? The undisclosed income will be aggregate of undisclosed income declared in the return furnished under 158 BC, undisclosed income determined by the AO on the basis of evidence found as a result of the search or survey or requisition of the books. And the undisclosed income will not include total income determined under 143.1, summary proceedings, assist under 143.3, 144, 147, 153A or 153C, right? Prior to the date of initiation of search, total income declared in the return of income under 139 or in a response to a notice under 142.1. Income computed by the assessee in respect of previous year where the previous year has ended and the due date for furnishing of the return has not yet expired prior to the date of initiation of search. Okay? Or the period commencing from the 1st April in the year in which search has been initiated and up to the date of the authorization. Clear? Any losses or unabsorbed depreciation shall be not set off against the undisclosed income. Any question, any doubt so far? So is this 158 BB very clear to everyone? Okay. Now, one more amendment with respect to that. Income relating to the international and specified domestic transaction during search proceeding. So where any income which is required to be determined as a result of search, right? is basically determined on the basis of entries relating to such income or transactions as recorded in the books of accounts or documents maintained in a normal course. If it relates to any international transaction or specified domestic transaction pertaining to the period from 1st April of the previous year in which the authorization was executed and the ending on the date on which last of authorization was executed, such income shall not be considered for the purpose of determining the total undisclosed income. Are we clear? Okay, students. So this is the provision with respect to the search, the changes that has been made in respect of the total income. Any questions, any doubt with respect to this? Yes or no? Yes. So, as I said, in respect of the search cases, there has been change in which the how the total income has to be computed. What has to be included, what has to be excluded. As I said, the income computed in respect of a previous year where such previous year has ended and the due date for furnishing the return has not expired prior to the date of initiation of the search on the basis of entries relating to such income or transaction as recorded in the books of accounts and other documents is not to be included. Okay? Or the income computed by the assessee in respect of period commencing from 1st April in which the search is initiated, or the period commencing from the date of initiation of the search if any income is computed by the assessee, or any specified domestic transaction or the international transaction. Now, what is the procedure for block assessment? The AO issues a notice requiring to furnish within the period which is not exceeding 60 days a return setting forth his undisclosed income. Then no notice is required to be issued under 148. This return will be treated as if filed under 139. And the time allowed for furnishing the return may be extended by a further period of 30 days by the AO, where the due date for furnishing the return of the previous year immediately preceding the year of search has not expired. Or the assessee was liable for audit under 44AB. The accounts of such previous year have not been audited on the date of issuance of such notice. And the assessee requests in writing for an extension of time for furnishing the return so that he may get the accounts audited. Are we clear? So under 158 BC, the time limit can be extended by further 30 days if the time limit of the return filing has not expired. The assessee is liable for audit. The accounts are maintained, but the accounts have not been audited and the assessee requests for the extension. In that particular case, one can extend the time limit. Are we clear? Then, what other change has been there? Where the AO is satisfied that any undisclosed income belongs to or pertain to any other person other than the person on whom search has been initiated. Right? In any money, bullion, jewelry, virtual digital asset or other valuable article or thing shall be handed over to the AO having the jurisdiction over such person. Where there is one specified person, the block period for such other person shall be same as 6 years. Where there is more than one specified person, then the block period shall also be 6 years. Same as that specified person, in whose case the block period ends on a later date. Okay. Additionally, in case of that other person, for the purposes of abatement, the reference to the date of initiation of search shall be construed as reference to the date on which money, bullion, jewelry, virtual digital asset or any other documents were received by the AO having the jurisdiction over him. Because the abatement will happen till the date when the authorization was received. Are we clear? Any question, any doubt? Fine. Okay. Any question, students? Any doubt? Yes or no? So these are the major changes which have happened with respect to the search cases. And you need to remember all of these. You have to remember all of these changes because these are very, very, very important, students. Okay. Any questions, any doubt before we move further? Fine. Okay. Then what is the other amendment in the assessment? Yes. What is the other amendment in assessment? Yes or no, students? Is there any other amendment? Yes. Fine. There is no other amendment in respect of the search. Okay. Any question, any doubt? Fine. Okay. Now let us move to then the next area. Yes, what are the other amendments? After the assessment. Yes, what are the other amendments after the assessment with respect to the penalties? What are the amendment in the penalties? Yes, students. What are the amendments in the penalties? So the time limit to impose the penalties has been rationalized. Yes, the time limit which are there to impose the penalties has been rationalized. What is the rationalization that has been created over here? Yes, students, faster. Yes. So the existing provisions of section 275, the existing provisions of section 275, which is there, it talks about the time limits. Yes, bar of limitation for imposing the penalty. So what rationalization has been created over here? It is now amended to provide that any order imposing a penalty shall not be passed after the expiry of 6 months from the end of the quarter in which the connected proceedings are completed or the order of appeal is received or the order of revision is received. Are you getting this particular point? So, in respect of the penalties, there are changes in the time limit. What is the time limit that has been mentioned? 6 months from the end of the quarter. Yes or no? Then what other change has been there? Yes. So 275 puts the bar of limitation for imposing the penalty, which says that no order imposing a penalty shall be passed after the expiry of 6 months from the end of the quarter in which the proceedings are completed of penalty if the assessment is not the subject matter of appeal, order of revision is passed, or the order of appeal is received by the jurisdictional PCIT or CIT, or the order of appeal from the ITAT is received by the PCIT or CIT, or 6 months from the end of the quarter in which notice for the imposition of penalty is issued. Are we clear? Any questions, any doubt? Yes. Then what other changes have taken place in penalties? Faster. Yes, students. And the 270 double A. What is 270 double A? There has been a change. What is 270 double A? Faster. Yes, what is 270 double A? Yes, students. Immunity from imposition of penalty and prosecution. Right? So an assessee can make an application to the AO for grant of immunity from imposition of penalty. Yes? So in that particular case, there has been an amendment. What is the amendment? What is the amendment carried out there? So the time limit for passing the order, accepting or rejecting the application for immunity. The AO shall pass the order accepting or rejecting the application for immunity from penalty, either under 270A for underreporting, misreporting, or for prosecution under 276 or 276CC within a period of 3 months from the end of the month in which the application is received. Earlier it was 1 month. Now it has been substituted to 3 months. Are we clear? So that has been a change in respect of the prosecution or the immunity from the penalty. Any question, any doubt? Yes. Then what other change has been there in respect of penalty? Yes, students, what other changes are there? Faster? Is there any other change in respect of penalty? Penalty for failure to deduct tax at source. Penalty for failure to deduct tax at source used to be there earlier. This has been now abolished. Are we getting this? So under 271C, for non-payment or belated payment of the TDS, there used to be penalty under 271C. If a person fails to deduct or pays the TDS. Now, no penalty can be imposed by the AO after 1st April 2025. Any penalty after 1st April 2025 shall be imposed, only by the AO, not by the Joint Commissioner. It is not abolished, Any penalty after the 1st April 2025 shall be only imposed by the AO in that particular case. So under 271C, the penalty can be initiated only by the assessing officer. So if any person fails to deduct the TDS or fails to pay the TDS, right under the when the consideration is given in kind, then the person shall be liable to a penalty equivalent to the sum failed to pay. Okay. So in that particular case, the penalty under 271 can only be imposed by the assessing officer. Are we clear? Earlier, penalty was imposable by the Joint Commissioner. Now it can only be initiated by the assessing officer. Fine. Similarly, there is penalty under 271CA. Penalty for failure to collect the tax at source. If a person fails to collect the tax at source, then also there is a penalty. That penalty also after 1st April 25 can only be imposed by the assessing officer. Now this is again very important. It can be asked in the examination. Are we clear? Then again 271D, which is failure to comply with the provisions of 269 SS. What is 269 SS? Yes. What is 269 SS? Mode of taking or accepting certain loans, deposits and specified sum more than 20,000. If you fail to comply, there is a penalty of the equivalent amount in the 271D. Again, that penalty can only be initiated by the assessing officer. Similarly, you have under 271DA, failure to comply with the 269ST, which is repayment of loan or mode of undertaking transaction. So not repayment, the mode of undertaking the transaction, that no person shall receive an amount of 2 lakh or more from any person in a day in respect of a single transaction, in respect of one single event. Otherwise than through account paid check. In that case, there is an equivalent amount of penalty, right, which is under 271DA. Again, that penalty can only be imposed by the assessing officer. Then, similarly, you have now 271DA. That is penalty for failure to comply with 269SU. What is 269SU? Acceptance of payment through other than electronic modes or prescribed electronic. Then a penalty of 5,000 per day is levied. That penalty is also now imposed only by the assessing officer. Isn't it? Similarly, you have the penalty under 271E. What is 271E? Failure to comply with the provisions of 269T. Right? So 269T is repayment. Again, a sum equal to the loan amount is done if the repayment is other than the banking mode, more than 20,000. Again, this penalty can only be initiated by the assessing officer. Are we clear? Any questions, any doubts? So these powers have been now given only to the assessing officer to impose this kind of penalty. Earlier it was with the joint commissioner. Now it is with the assessing officer. Are we clear, students? Yes or no? Any doubt, any question? Fine. Next is obligation to furnish information on transaction in respect of a crypto asset. So a new section 285BAA has been inserted to now provide that there will be an obligation to furnish information with respect to the crypto asset. So a reporting entity, which may be prescribed, who is a reporting entity, in respect of a crypto asset shall furnish the information in respect of a transaction of such crypto asset in the prescribed statement to the income tax authority. So this will be prescribed. So it can include the exchanges, it can include the wallet holders, the operators, and accordingly, this will be required to be reported. Are we clear? Yes or no? Any question, any doubt? Now, another amendment that has been made is in respect of the transfer pricing. What is the amendment in respect of the transfer pricing provision? So, there has been this applicability of the multi-year transfer pricing or the ALP, which is there. There has been the applicability of the multi-year transfer pricing provision. Are we clear? Right. Now, what does it say? The amendment in section 92CA talks about it. That transfer pricing provisions allow the calculation of the arm's length price. Right? It is amended to provide that the ALP in relation to international transaction or specified domestic transaction for any previous year will apply to the similar transaction for 2 consecutive previous year immediately following that previous year. Now, what does this mean? So, in respect of the transfer pricing provisions, right, you calculate the arm's length price for 1 year. isn't it? You calculate the transfer pricing for one particular year. Now what they are saying is that in respect of this particular transfer pricing which you are calculating under 92 CA, when you make a reference to the transfer pricing officer for computation of the arm's length price, right? So where any person has entered into international transaction or specified domestic transaction, the AO with the previous approval of the PCIT or CIT can refer the computation to the TPO. And where such a reference is made, the TPO can determine the arm's length price. Now there has been a concept of block transfer pricing assessment scheme on the specified domestic transaction, which allows to apply the ALP determined in relation to a specified domestic transaction for any previous year to a similar transaction for the next two previous year. If the transaction is similar, then in that particular case, the same transfer pricing can, or the same arm's length price can apply. Are we clear? Any question, any doubt? Clear? So that in case where the reference for the computation of the ALP is made, right? Then in that particular case, this only can be done, not you can do. Clear? Any doubt, any question? But the option has to be exercised by the assessee itself under 92 CA. The option will be exercised by the assessee itself. Clear? Any question, any doubt? Okay. So what happens in this case? To reduce the compliance burden on the assessee as well as even on the administrative burden on the TPOs, this block transfer pricing assessment has been introduced, which allows to apply the ALP determined in relation to international transaction for two consecutive previous years and even for the specified domestic transaction. So the ALP determined in relation to the international transaction or specified domestic transaction shall apply to similar international transaction for the next 2 years, where the assessee exercises the option for the next 2 years in the prescribed form, manner and within the prescribed period, and the TPO within 1 month from the exercise declare that these options are valid. However, this will not apply if there is any search initiated, if there are proceedings for assessment of search cases. And once the TPO has declared that the option exercised by the assessee is valid, then no reference for the computation of arm's length price shall be made by the AO to the TPO. Are we clear? Any question, any doubt? And where the TPO has declared that the option exercise is valid option, he shall then examine and determine the arm's length price not only for this year but for the similar transaction for the next 2 consecutive previous year. And the AO will proceed to recompute the total income as per the provisions of the considering the TPO's order. Are we clear? Right? Now then, what are the changes in respect of the trust provisions? What are the changes in respect of the trust provisions? Yes. What are the changes in respect of the trust provisions then? The last one. Yes. Increase in the period of registration for the smaller trust or institution. The validity of the registration of the trust or institution was earlier 5 years. To reduce the compliance burden for the smaller trust or registration, the period of validity of registration will be now 10 years for the trust whose total income does not exceed 5 crore rupees during each of the 2 previous years preceding the previous year in which the application has been made. For other trust, the registration period remains 5 years itself. Yes or no? But for these kind of trusts, it will be 10 years if their total income for the previous 2 years do not exceed the 5 crore. For each of the year, you have to see that. Are we clear? Then, under section 13, prohibited person are there. Any transaction with prohibited person results in violation of the conditions of the trust, cancellation of the registration of the trust, right? Denial of the exemption. So section 13 provides that the provision of 11 and 12 will not apply if the income or property of a trust or institution is applied for the benefit of specified person. These include any person who has made the substantial contribution to the trust. That is, whose contribution exceeds 50,000 and whose total contribution exceeds 50,000 and is relative and any concern in which the person has a substantial interest. Now, that has been increased to 1 lakh rupees. Contribution during the previous year exceeds 1 lakh or an aggregate exceeds 10 lakh. Further, the relatives of such contributors will no longer be considered as specified person. And the concern in which these contributors have substantial interest are also excluded from the meaning of the specified person. Are we clear? Any questions, any doubt? Okay. Is there any question? Yes or no? Fine. Then what other amendments are now left out? Few ancillary amendments. One is in respect of any income accruing or arising by or received by a specified fund as a result of transfer of capital asset, which is the what capital asset? Which is basically this particular listed securities, right? So in that particular case, the income is considered as exempt under section 10(4)(d). Isn't it? The income is considered as exempt under 10(4)(d), any transfer of the capital asset being the bond, rupee denominated bond, derivatives, right? So in that particular case, 10(4)(d) excludes such income. It says the income is exempt if the transaction is taking place on a recognized stock exchange located in an IFSC and the consideration is paid or payable in convertible foreign exchange or as a result of transfer of securities or any income from securities issued by a non-resident and where such income otherwise does not accrue or arise in India, right? Or any income arising from a securitization trust which is chargeable under PGBP to the extent the income is accrued or arising to or is received by a non-resident. Right? So in this case, what is the investment division of offshore banking unit? It means an investment division of a banking unit of a non-resident located in IFSC and which has commenced its operation before 2025. So this has been extended to 2030. That's it. So a very small change has been carried out. So this investment division of offshore banking unit has been extended. Are we clear? Yes or no? Fine. Okay. Next is in respect of a specified fund also. So as I told you that any income arising to a specified fund. Now what is a specified fund? Specified fund is again the one which has been granted the certificate of registration or the investment fund division of an offshore banking unit which has been granted a certificate of registration and commenced operation before 31st March 2025. This has been again extended to 2030. Clear? Then in respect of 10(4)(e), which is income accruing or arising to a non-resident as a result of transfer of distribution of income from the offshore derivative instruments. Their over-the-counter derivatives are also included. Okay. Then in respect of, again, 10(4)(f), which is any income arising by way of royalty or interest on account of lease of aircraft or ship by a unit of IFSC which has commenced its operation before 31st March 2025. Again, this has been extended to 2030. Similarly, in 10(4)(h, again, the same thing has been done. Any income of a non-resident or a unit of IFSC which is engaged in leasing of aircraft or ship. So earlier it was only restricted to leasing of aircraft. Now it has been extended to ship also. Where the income is arising by way of capital gains from the transfer of equity share of domestic company, which is a unit of again IFSC, which is engaged in the leasing of aircraft or ship, which has commenced its operation before 31st March 2025. This has been again extended to 2030. Are we clear? Fine. Any questions? Any doubt? Yes or no? Then under 1034, under section 1034, there is again an exemption which has been given in respect of the 1034A, sorry, in respect of the income of the unit of IFSC which is engaged in the leasing of aircraft by way of dividends from a company being a unit of IFSC. The earlier one, 10(4)(h) we saw is for capital gain. There again, if the dividend is received from a unit of IFSC which is engaged in business of leasing of aircraft, there again the ship word has been extended. Are we clear? Any questions, any doubts, students? Yes, is everybody clear about this? Okay, fine. So these are some of the exemption provisions which are there. Now, one more important thing is with respect to the equalization levy. So with effect from 1/4/2025, the 6% equalization levy on online advertisement has been abolished. So earlier, income subject to equalization levy used to be exempt. Now the equalization levy itself has got abolished. Are we clear? And the last amendment that is there, which is with respect to the presumptive taxation scheme for non-resident providing services for electronic manufacturing facility. So a new section 44 BBD has been inserted to provide presumptive taxation regime at the rate of 25% for non-resident engaged in the business of providing services or technology in India for the purpose of setting up an electronic manufacturing facility or in connection with manufacturing or producing electronic goods, articles or things. So for them, a 25% presumptive rate is applicable. Now this particular concessional rate which has been given is given under section 44 BBD. Right? And the amount will be the amount paid or payable to the non-resident, right, on account of providing services or technology, and the amount received or deemed to be received by the non-resident for account of providing services or technology. And the provision of 44DA or 115A will not apply in this case. Are we clear? And no set off of the unabsorbed depreciation and brought forward losses shall be allowed to the assessee also. Clear? So this completes your statutory updates. Now let us move to the judicial updates. So what are the cases which are applicable for you? This is the first case with respect to, okay, but before, sorry, we go on to completing the amendments. I just wanted to check with you. Are there any amendments under the appeals and revision? Yes, you need to tell me before we go on to the judicial update. Are there any amendments with respect to appeal provisions? We did not discuss about that. Yes. We do not have any amendments, or do we have amendments? Yes or no, students? Faster, I need your answers. So there are amendments with respect to the appeals also, but very minor amendments. These are just clarificatory amendments, nothing more. Okay. So let us proceed to the judicial update. This question is before the Bombay High Court whether a subsequent ruling of the court can be a ground for invoking the provisions of 254(2) by the tribunal to rectify its own order. So under 254 section, the tribunal has the power to rectify its order. Right? The orders of the tribunal has the power within any time, 6 months from the end of the order in which it was passed, can rectify a mistake apparent from the record. Right? So can a subsequent ruling of the court be considered as a mistake apparent from record? So what were the facts of the case? The AO disallowed under 3615A that the employee's share of the PF and ESIC was deposited belatedly. The tribunal passed the order, allowed the deduction, holding that the amounts were paid on or before the due date of filing the return of income. Subsequently, the Supreme Court held that the deduction in respect of employee contribution are permissible only if the amounts are deposited within the due date of the fund and not by the due date of filing the return of income. Based on this judgment, the revenue filed an application for rectification, which was allowed by the ICAI, thereby reversing its earlier decision. So can the ICAI do that? So the Bombay High Court held that a subsequent judgment, even of the Supreme Court, forget Bombay High Court, forget the jurisdictional court, even of the Supreme Court cannot by itself form the basis for rectification under 254(2). Such rectification is limited to apparent mistakes and does not extend to reviewing or reconsidering the decisions based on subsequent legal development. Accordingly, the ITAD's jurisdictional order is without any, ITAD's rectification order is without any jurisdiction. Are we clear? Any questions, any doubt? Are we clear? So this particular decision which was there is prior to the amendment in the Income Tax Act. What amendment? The explanation 2 to section 3615 clearly provides that the provisions of 43B permitting the deduction up to the date of filing the return of income would not apply to employees' contribution. The same is to be deposited before the due date of the fund. So this case law pertains to the period prior to the amendment. However, the question of law in the present case with respect to sustainability of the rectification of its earlier order based on a subsequent court ruling continues to remain relevant. That means if tomorrow the court comes up with a judgment, the tribunal cannot rectify the order. Clear? The second ruling is of the Calcutta High Court. In the case of Crown Electromechanical Private Limited versus PCI. What was the question? The question was whether an inadvertent omission in the income tax return can be rectified by the principal commissioner under revision under 264. So here the associate filed the return declaring the total income. However, he inadvertently failed to include certain figures in the P&L account, and this error led to the assessed total income being determined at 3 crore 58 lakh instead of correct 9 lakh, resulting in a tax demand of 1 crore under 143(1). By the time the assessee received the intimation, the time limit to file a revised return had expired. So the assessee filed a revision petition under 264 before the PCI, relying on the tax audit report to support the correct profit figure. Now, having regard to the tax audit report, it was contended that the profit is only 9 lakh and not 3 crore, as determined in the 143(1). PCIT rejected the application on the ground that the PCIT is not competent to alter the return filed by the assessee. What did the High Court held? The High Court held that under the scheme of 264, the revisional authority is empowered to grant relief even in cases where the mistake is committed by the assessee. So usually, what is 264, students? The 264 is the revision of the order by the PCIT. Right? 264 is in case of any order, right, which is passed by the authority subordinate to the principal chief commissioner or chief commissioner or PCIT or CIT, and can rectify or can revise that order on the application made by the assessee. Now the question is here, this was the return and not in order. So can the PCIT revise a return? So the court held that such bona fide mistakes are rectifiable under 264. And the PCIT in fact erred in rejecting the petition without considering this principle, and therefore the matter was remanded back to PCIT for reconsideration in the light of this observation. Are we clear? Next is the Supreme Court judgment in the Pride Foramer essay. The question was whether mere failure to obtain a business contract would be sufficient to hold that the assessee had ceased its business activities in India. So the assessee was a non-resident company incorporated in France who was engaged in oil drilling activity, and he had a 10-year contract for drilling operations in Mumbai and obtained another drilling contract in 1998. Now, during the intervening years, it carried on business corresponded with ONGC from abroad and submitted a bid for oil exploration in 96. During its period, it incurred significant administrative and audit expenses and filed a nil return, wherein it collected only interest on income tax refunds and set off the business expenditure and claimed the set off of unabsorbed depreciation against the income. The AO and CIT disallowed business expenditure and set off of the unabsorbed depreciation on the ground that no business was carried on by the assessee during the previous year. The tribunal took the note of the correspondence and the bid submitted, treated the relevant period as temporary lull in business activity and accordingly allowed the claims. However, the High Court reversed the order of the tribunal on the ground that the appellant did not have a P and corresponded with ONGC from its foreign office and cannot be said to carry on any business in India. The matter reached to Supreme Court. The Supreme Court observed that during the intervening years, it is not that the assessee did not carry out any business. Because what does section 28 say? Profit and gains from the business carried on by the assessee during the relevant previous year. Now the question here was, did the assessee carry out to claim the expenses? You will only be able to claim the expenses under PGBP. You will only be able to compute the profit under the PGBP if you have carried on the business during the previous year. What do we mean by carried on? The Supreme Court observed that during these years, when the assessee was actually not doing the business but was corresponding with ONGC with regard to hiring of manpower services in respect of expert key personnel for drilling in deep waters, and had even submitted a bid, even though it was unsuccessful. The tribunal noted correctly that the business was going through a lean period, which could be revived if proper circumstances arose. This may be termed as temporary lull in business and not a complete cessation of the business. So the Supreme Court held that the inference that the assessee could not be said to carry on business in India because it was corresponding from foreign country and was not having any office or permanent establishment here in India was fallacious. For computing the profit and gains from the business, all it is required to carry out the business, and it does not require that a non-resident have a office or a permanent establishment within the country to offer the income to tax or to say that the income is accruing in India. So the Supreme Court held that an era of globalization whose lifeblood is transnational trade and commerce, such a restrictive interpretation that a non-resident company should have some P and it cannot be said to be doing business if it is doing the correspondence to a foreign country is incorrect. It is not in line with India's commitment to sustainable development goals relating to ease of doing business. So the Supreme Court held that the assessee was carrying on the business and was therefore entitled to deduction of the business expenditure. Are we clear? Any questions, any doubt? Fine. The last case Salesforce.com Singapore PT. Supreme Court decision. The question was whether the subscription fees received for providing the access to a customer relationship management application to Indian customer is royalty under section 9 of the Income Tax Act, or is it a fees for technical services under Article 12(4)(b) of India-Singapore DTL? So the assessee was a resident of Singapore. It provided customer relationship management related services through a business application to the Indian customers who used to pay subscription fees. Now in this case, whether it is royalty. Now what is royalty? If you look at section 9 of the Income Tax Act, let us have a look at section 9. Which section defines royalty, students? 916. Income by way of royalty payable. 916. The explanation 2 talks about, for the purposes of this clause, royalty means a consideration for the transfer of this particular transfer of all or any rights, clause 5, in respect of any copyright. So it has to be transferring some copyright. So royalty means consideration for either transfer of all or any rights in respect of patent, invention, model, design, secret formula or process or trademark or similar property. This is not patent, this is not invention, this is not model, this is not design, this is not secret formula. This is not a process transfer, this is not trademark or similar property. Imparting of any information concerning the working of or use of a patent invention. This is not imparting of information. This is not even use of patent and all of this. This is not imparting of any technical, industrial, commercial or scientific knowledge. This is not use of any industrial, commercial or scientific equipment. So the only option is transfer of all or any rights in respect of any copyright. So the question before the Supreme Court was that, is it transfer of the copyright? When do we say there is a transfer of a copyright? When I allow the payer of the subscription fee to modify that software, right? When you purchase MS Office, when you purchase Tally, can you modify the source code? No, you are using it as a service. You cannot alter the code of the software. You cannot change something in the software. When you get what the user has the right, that is copyright transfer. But when you are just like a lessee, you cannot alter the building. You do not have the rights of lessor. Then it is not a rent. When you can stay in the premises as the owner can stay, then you pay the rent. Rent is equal to royalty. Rent is for the movable property, immovable property, tangible. Royalty is for intangible. So in the copyright also, when I say I transfer you the copyright, I give you the ownership rights. Even though limited, but I give you the ownership rights. This case, the copyright was not transferred nor vested to the subscriber. They were just using some service. So it cannot be said that this is royalty. The customer was merely accorded the access to the application and take advantage of the attributes of the software by providing the requisite data. The subscription fee would not fall even within the ambit of the fees for technical service. Because what is fees for technical service? Fees for technical services, when I'm giving you some technical information, some managerial, some consultancy information. Is it managerial information? Am I doing some management work of yours? No. Is this consultancy that I am doing? No. Is it some technical information? No. Supreme Court in Bharti Airtel had held that there has to be some human intervention to provide a service. Automated services are not technical service. Supreme Court in Kotak Securities held that the general services are not fees for technical service. It has to be a specialized service where I'm giving you some specialized knowledge. Here, this was an automated service. It was provided customer relationship management related services through a software. There was no copyright transfer because the subscriber cannot do what the owner was able to do. Here, there was no fees for technical services. because here the subscriber, the payer of the services, was not getting some technical information, some managerial information, some consultancy information. So it was not fees for technical services also. Are we getting this particular point, students? So what is fees for technical service? If we look even under the Act, here they've referred about DTA, but even under the Act and DTA, the definition is same. It says fees for technical services means, what is fees for? Means any consideration for the rendering of managerial, technical or consultancy service. This is neither of them. So here, the Supreme Court here held that it will not interfere with the decision of the High Court. And the decision of the High Court is fine. Are we clear? So these are the judgments which are applicable for your particular attempt. Right? These can be again asked in the form of the case scenarios. Right? All of these are important. And you should be writing in this manner only. What are the facts? Also quote the provision involved. Like I told you, what does the section for royalty says? What section 254 says? That only mistake apparent from record can be rectified. So you have to write that relevant provision. Unless you write that relevant provision, you will not be getting the proper marks. So write the relevant provision. Are we clear? Any questions, any doubts so far? Yes. Yes, students, any questions, any doubt? Yes or no? Okay. Yes. Any questions, any doubts so far? So these are the amendments which are applicable for your attempt. Please revise it properly. Pay attention to these amendments because these are very, very important. There are not major notifications and circulars which are applicable. So you have to pay attention to the Finance Act 2025 amendment for your attempt. Finance Act 2025 is applicable to your attempt, and these are the judgments which are applicable. So you need to do this, all of it properly, and do it with the relevant chapter rather than doing it separately, right? Because that will help you to prepare and have a link with the particular topic. Are we clear? Okay. So if there are no further doubts, I think we can conclude the session over here because these are all the amendments that I have covered for your attempt. Yes, Ashok ji? Yes, over. Thank you. Good night.